afternoon, and thank you for joining us for this afternoon's live call, Weathering the Coronavirus Market Downturn. My name is Darcy O'Brien, and I'm the Chief Marketing Officer at Simon Quick, and I will be moderating today's discussion. First of all, I would like to thank each and every one of you for joining us today, and a special thanks to those of you who have been joining us regularly these past couple of weeks. It is your participation that makes these calls educational and impactful for everyone. At Simon Quick, we have clients from a wide variety of backgrounds, and so it follows that there are a wide variety of topics and interests among this group. Just like our teachers used to say in grade school, there is no such thing as a dumb question. If it's on your mind, chances are someone else is thinking the same thing. So please do not be shy about submitting your questions. On that subject, please note that questions can be submitted through the Q&A function on Zoom. You may also submit questions by emailing me at dobrien@simonquickadvisors.com. Please note that this call is being recorded and it will be posted onto the blog section of our website tomorrow and circulated over email. Now, before we dive into the questions, please note the following disclaimers. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. Okay, so let's introduce our panelists. Today we have with us our Chief Investment Officer and Managing Partner, Chris Moore.
Thanks, Darcy. It's a pleasure to be here.
Hi, Chris. And Chris, if you're on speaker, just make sure to adjust your headset so that we can all see you, or all hear you rather. We also have with us our Head of Investment Research, Wayne Yee.
Hey, Darcy. Glad to be here.
Hi, Wayne. Okay, so we've already received a few questions over email, and so I'm going to kick them off. The first question that came in is from Bill, and he says, we saw such extreme volatility in March. At one point, we were down 25%, and then we ended down only 12%. It's not really a question, but I wondered if you could comment on how extreme March was.
This is Chris. I could start on that one, and I'm sure Wayne will have something to add as well. March really was an extraordinary period for the markets. And the reality is no one was expecting the coronavirus outbreak to impact public health and the economy as much as it has already to date. And it really did create a black swan event for markets, a total surprise. You know, something that no one could have even imagined would be a factor in this year's markets. There were plenty of concerns around corporate credit or the large cap tech stocks inflating in value and IPOs coming to market within technology that were venture backed. And, you know, was there potentially a bubble in that universe? Everyone was talking about other risks to the market. No one was talking about a global pandemic. And it took every investor completely by surprise. To put it into context, it was the fastest 10% correction the market has ever experienced, even more so than the Black Monday of 1987. So the fastest that the market went declined by 10% in any period. Secondly, it was the quickest in history for the market to go from a recent high to a bear market, which is a 20% decline, which was 6 days. So by purely putting it into context, it was the fastest 10% decline and fastest 20% decline from a bull market peak in history for the market. And I think the speed at which it declined was due to some of the factors I just mentioned, but also due to a lot of technical factors that are in the market today that were not in the market pre-08, that were not in the market in the 01 recession or the recession of 1987. And those technical factors just amplified the downturn. Wayne, anything you want to add?
Yeah, I mean, when you just look at the month-end returns, obviously they're all negative, but they don't look awful kind of in the context of the volatility that we saw and kind of what drove that. I mean, like just using the S&P as an example, for March, we're down a little over 12%. Down 12% in a month is bad, but it doesn't point to the down 25, near 25%. We were down just a little over a week prior to that. Like the trough of March was, I think, the 23rd, where the S&P was down 24%. And then the ensuing kind of slightly over a week, we made back half of that. Like that's a pretty volatile swing on the way down and on the way up. And I think while the absolute kind of the month-end numbers are meaningful, I think the swings of volatility in that period are pretty dramatic. And we continue to see a lot of dispersion in the midst of that as well, where equities, as I mentioned, down 24 at its trough, kind of rallied in the final few days to be up, to be down only 12%. But then when you look at the Russell 2000, looking at the small cap index, that was down over 30% in the from March 1 through March 23rd, and then was still down 22% at the end of the month. So that didn't rally back as hard as large caps did. Fixed income, that's another area where we saw significant volatility, and we've touched on this probably the past 2 weeks calls as well. But preferreds, kind of double B, high quality kind of issuances out of large banks that don't have any default risk, like that was off 27-28% on the month, and then in the final few days it rallied to be only down 13%. But these are some pretty dramatic swings where it was the confluence of investor sentiment in terms of where fundamentals and earnings will be and what the macro environment looks like, in addition to this concern about liquidity and financing and will the financial system in the U.S. seize up on the back of all this. So I think the Fed and Congress has done a lot to address that, and that's what we're seeing the benefit of currently. But in the depth of the worst of it, the numbers, the sell-offs are pretty dramatic. Just finally, you look at munis, municipal bonds, like investment-grade, high-quality municipal issuers. That index is down almost 11% on the month. Like 11% when you put that in context of the Barclays Ag being down less than 3%. So there was a big dislocation for that perspective, and that market still ended down nearly 4%, 3.6%. So, yeah, there was significant volatility in the middle of March, and obviously there's still more to recover from here, but that's kind of where the opportunity set lies going forward.
Thank you, Chris and Wayne. The next question in our inbox comes from Gail, and she asks, which investment opportunities or strategies are the most exciting to you in today's environment? Is there anything particularly unique due to this volatility that wouldn't be attractive in more normal conditions?
This is Wayne. I'll touch on a few things that we've been spending time on from the research perspective. This is stuff that not necessarily, we didn't go from ground zero to start working on it in the past few weeks, but rather things that we've been keeping an eye on, and the opportunity that has gotten that much more dramatic and interesting for us to be able to kind of dial up that effort. Obviously, when you look at equities, I think we've spoken a lot about where in the equity market that we like, and obviously it's an easy way, it's pretty transparent to look at equity markets to see if the stock market is doing well or not. And over the past, let's call it a couple of weeks, it looks like the markets are definitely kind of bouncing back here. We're up like north of 20% from the trough. So the markets feel good from an equity perspective. That was a dramatic sell-off on the way down, and it's a pretty kind of healthy recovery kind of in the earlier innings of what looks like a resolution to this pandemic. But other segments of the investable universe have not yet recovered or are still pretty beaten up. And I think there are some really interesting kind of multi-year opportunities in that space. Maybe I'll just kind of talk a little bit about that. And a lot of that tends to be in the credit space. We touched a little bit about distressed maybe a week ago. Distressed investing as a whole is pretty attractive. It's also countercyclical to what equity markets are doing and equity fundamentals are doing. So it's it's a nice balance to what's going on in stocks. But distressed as a nomenclature is really broad. So kind of where are there specific areas or pockets where you've seen particular dislocation that still requires effort and can still drive significant returns over the next several quarters and years. As I mentioned earlier, high yield at its trough was down nearly 19%. We've made back probably about half of that so far just in the vanilla index. But when you start looking at more complex instruments and securitization, structured credit, okay, when you throw those kind of names out there, people start getting a little nervous in terms of what that actually means. But there are, let's call it, a securitization is an aggregation of a lot of different underlying loans and obligations, whether they're from consumers, small businesses, maybe small companies that have loans out there. And a securitization pulls those assets and kind of parses out the risk and return opportunity based on individual risk appetite. So looking at basic kind of credit structure, AAA being the top of the capital structure at the at the highest level, you will, it is highly likely that you will make all your money back with none, very marginal, if any, losses. Versus if you look at the equity or the lower rated tranches, you're probably making typically mid to high single digits type returns, but there is greater risk of principal loss or some component of losing a portion of your principal. So just kind of thinking through that capital stack, an investor can say, all right, I am risk averse, so I just want to buy things at the highest end of that capital structure, or I'm a risk seeker and I'm going to buy stuff at the bottom end of that capital structure. Now, pre-crisis, kind of, let's go just say into February, structured credit investors did not expect to make a lot of return owning the AAA, but that was a highly defensive, conservative posture. Very strong liquidity. It aligns with all other things. Right outside of treasuries, it'd be the next asset class that people would buy for kind of principal protection with marginal interest income. What happened in the middle of March was that as the market sold off, people didn't want to sell the most liquid stuff. Sorry, they didn't want to sell the riskier stuff because that was the stuff that was selling off dramatically, right? If you think about equities, stocks were off 24%. You don't want to sell something that's down 24%. You'd rather sell something maybe that's only down 5% or barely down and use that to buy whatever's cheaper. Or if you need to pay an obligation, you would sell what hasn't had this big dramatic sell-off and use that to fund whatever obligation or cash need on the other side. What we saw in March was there was this huge exodus of investors out of the most liquid, safest parts of the capital structures in order to raise outright cash. You saw that in the municipal market, you saw that in the investment grade market, and you saw that in the securitized structured credit market. And just to kind of put those numbers into context, we saw AAA paper trading off 4 or 5 points. If you think about that number in itself is not that big. But on the flip side, what you had were whether they're institutional investors, insurance companies, other holders that had put some leverage on that AAA paper. And even if you did one turn of leverage, your 4 or 5% loss became a 10% loss. And then you had to sell that to meet potential margin requirements or liquidity needs on the other side. And what you saw in the first half of March was dramatic selling in the highest quality paper. And that was what really kind of persisted for the first 3 weeks of the month until it got to the end of the month where the less liquid stuff really started getting sold off pretty dramatically. And kind of that actually created a really interesting opportunity set here because you're seeing AAA paper, like the highest of the investment grade quality, yielding a lot more attractive opportunities. And we're seeing some of our managers being able to express some of those investment opportunities today. And this is kind of really timely right now, but one of our higher conviction ideas that we're seeing in the space is in, I'm going to call it TALF investing, T-A-L-F. There's a lot of complexity around it, but really it's a way for the government to support the liquidity in the financing markets on these AAA high quality pieces of paper with private investors. We have an investor that we have a relationship with an investment fund that has done this through the global financial crisis in 2008, and is now able to take advantage of this opportunity set again. We're looking at an opportunity set where you can make mid-high teens returns, owning the highest rated paper in these stacks, and that's highly compelling because the sell-off was technically driven, not fundamentally driven. And to be able to be a liquidity provider in the highest and safest assets, that's really attractive. And I think that complements really well with other things that we're seeing in traditional structured credit and distressed. But there's like a near-term visibility in terms of the opportunity set and the rationale and the principal protection you could get in owning safer assets. So that's something that's really compelling and interesting and something that we would love to be able to talk to clients and investors for.
Okay, great. Thank you, Wayne. Our next question comes in from Clive, and he asks, please let me know what is happening to bonds and how they are faring in this down equity mortgage environment.
Yeah, I'll answer this in a shorter way, but liquidity is coming back now because the Fed has provided a lot of backstop facilities and is offering financing and liquidity to the banks as well as other investors to normalize the market. We're not fully there yet, and I think that's where you're still seeing a lot of these discounts, but liquidity is coming back. You're seeing a lot of funds out there also being launched right now to take advantage of these kind of shorter term opportunities. So liquidity is coming back, but we did see a dramatic period of illiquidity for just several days, but it was enough to really kind of squeeze out parts of the market and create weak hands that held good assets, that had to sell good assets just to meet their own leveraging requirements. And in that comment, there's a question about mortgages, and I don't know if that's kind of underlying mortgages of individuals, but mortgage REITs have been one of the main kind of weak hand holders that got punished pretty hard in this market, being down anywhere between 40 to 80%. They're high quality assets that they own, or there are a lot of high quality assets they may own, but because maybe leveraging or the structure of their financings are causing them to sell and be in a bad position, that is creating some other opportunity. But it's part of the illiquidity that we see in the markets that's been driving some of these potential opportunities.
Okay, thank you, Wayne. Our next question comes in from Greg, and he asks, is the worst behind us and have we turned a corner?
I can start with that one. I think it's too early to know if the worst is behind us. There are kind of three factors that the market is still very much keeping a close eye on to figure out if we test the lows or continue to kind of gradually move higher from here. It certainly feels like in this 20% rebound, the market is responding favorably to the Fed and Treasury stimulus packages and monetary policy moves. The three kind of areas where the market is laser focused to figure out whether or not things are going to get worse from here or better from here are, first and foremost, are we at a point where the rate of the spread in the virus and the deaths from the virus are peaking or plateauing, or ideally, coming back down and declining, such that the point at which everyone can get back to work again is maybe sooner than many were predicting. There's been some evidence to support that in some of the countries in Europe, in New York City, Governor Cuomo has said he thinks the worst is going to be this week, and we're seeing, somewhat of a a slowing of the number of ICU patients, and he's optimistic that this week or potentially next week will be the peak. There are other parts of the country that haven't been hit as bad, and maybe the virus is kind of behind them at this point. So that is kind of the first factor that the markets are trying to digest. Are we peaking, and is the rate of the spread declining and the number of deaths declining, or nearing a decline? The second is, what is the impact to the economy? There's been a lot of projections, some of them really dire. Bank of America, Goldman Sachs came out with some pretty dire projections for economic growth and unemployment, specifically here in the U.S., but also globally. And the assumptions that are baked into those projections are really dependent on how long the shutdown lasts, right? Governor Murphy announced last night an extension of the state of emergency in New Jersey for another 30 days. New York is certainly still in a state of emergency. What other states are all of a sudden going to come back to market sooner, where folks can maybe get back to work? That economic impact is really an unknown at this point until we start to see hard data around unemployment, around GDP growth for first quarter. We won't really kind of know how much the economy is in fact impacted. So that's the second factor. The third is the potential for the virus to resurface in the fall, and what kind of vaccines are available and widely available, frankly, to prevent the possibility of that happening, and kind of witnessing the Spanish flu-like scenario of 1918, 1919, where it was a W-shaped recovery as opposed to a V or U-shaped recovery. And the theory that the folks that have abided by the stay-at-home order and are not out and about and are not exposed to anyone with COVID-19 don't have any immunity whatsoever. So when they're eventually put back into the workforce, the potential for them to all of a sudden get the virus and then have kind of a second wave of spreading in the fall. So I think those three elements are very much front and center for markets, and we'll see. Time will tell if any of them have an impact, or maybe we have another stimulus package here to support the SBA financing and the PPP, and maybe the Fed continues to aggressively purchase assets in the market, and we slowly recover out of this, and the worst is behind us. So I think we're in a good place right now, based on maintaining a neutral exposure to equities, which is where we got throughout the last couple of weeks within our asset allocation. If we were to see a position where maybe we tested lows again, I'm not saying that's likely, but if we did, or if we all of a sudden got much more confident that outcome for the economy and the spread of the virus was more positive, that could potentially lead us to increase our equity exposure. But at these levels, we're not increasing them any further than we've guided to this point.
Thank you, Chris. The next question in the queue comes from Rana, and she writes, I was put into PE funds last year, and I'd like to know, why are these still good opportunities?
I could start with that one, and Wayne can jump in. Most of the PE and venture funds that we've allocated to within the last year have actually been really slow to call capital, because prices were high last year. It was harder for the average PE fund that we allocate to find a deal that they liked at a price that they liked. And a lot of them were slow to put capital to work last year and wanted to kind of wait it out until valuations were more in line with their process and philosophy. So that leaves a lot of them with dry powder today. And all of a sudden, in an environment where companies are looking for liquidity, they're looking for capital, it puts those private equity funds at an advantage now because they can buy assets that they liked a year ago at a much cheaper price. We had one venture fund comment about they bought a new company within their fund in just the last 2 weeks at valuation that was 35 to 40% lower than they thought they would have had to pay for it. And they kind of said a lot of that was a function of what's happened in markets today. So the short answer is we still like the illiquid private market as a way to gain returns for long-term capital. And we think the fund managers that we've hired are going to do really well identifying attractive opportunities at good prices when a lot of those companies are in need of liquidity based on the last 90 days. The one caveat to that certainly is there will be businesses that will be more impacted than others by the spread of the virus and what it's done to those businesses. I mean, restaurants in particular or office space in particular will be more impacted because of behaviors changing, and that could provide an opportunity for funds that have uncalled capital to invest in those industries or asset classes that they think are poised to recover when the economy's back on track.
Thank you, Chris.
Yeah.
Sorry, Wayne.
Yeah, just one quick comment on that. Private equity investments tend to be a multi-year investment versus if you're just looking at the equity market or the bond market, where if the markets recover and recover quickly, obviously that 1 year of performance in public equities will outpace a 1 year return in private equity. But in private equity, we're looking for several points of outperformance over a multi-year cycle, typically something in the 10-year type period. And that in itself is really attractive versus a long-term rate of growth of return from the public equity market, kind of if you're just looking at the S&P. So for a long-term investor that can look beyond just kind of the bouts, the fits and bouts of kind of short-term business cycles, private equity continues to make a lot of sense, and there's active engagement that you can't necessarily do in a public perspective that makes the asset class really still really interesting.
Thank you, Wayne and Chris. Our next question comes in from Joshua, and he asks, do you feel that the more negative numbers predicted by Goldman Sachs and others is baked into current market levels? Or do you think they are baked on more mild assumptions, meaning market levels?
I could take that one and then love to hear Wayne's opinion too. Personally, I think it's good that some of the forecasts for economic growth have come out as extreme to the downside as they have, because I do think it is good for market participants to digest the possibility of those outcomes. If I was to say, has the market fully priced them in? Probably not fully, but if you were to kind of average out all of the expectations for the economy from the most positive to the most negative, I would say we're probably somewhere between the average and the most negative. I think the market is tending to favor a more negative outcome, but we're probably moving to somewhere in the middle in the last week and a half. I think the 20% rally here is the market moving away from the most kind of dire scenarios and thinking that things may not be as bad as some of those early projections were indicating.
Yeah, I mean, I don't know if you recall, but Christmas or December, just looking at the market, the stock market, looking at the economy in that holiday season, the economy was humming. Like those are really strong numbers. So I think there is an expectation that, you know what, when we get out of this, the pandemic, we're going to go back to where it was. And I think the market's probably pricing in more of a sharp V than a U or let's call it a slanted L or something. So the rebound is what I think the market's really hoping in on, given that if you shut down dramatically in a short amount of time but can reopen, then businesses can weather that short-term impact and continue on. Now, if the pandemic were to continue longer, and I think this is where people are taking the other side of, the longer the pandemic, the longer businesses shut down, the less likely they can come back. So as that becomes a smaller and smaller possibility, the market is kind of leaning more towards a potential V-like recovery. And I think some of the kind of price action you've seen more recently has been on the back of that. But yeah, I mean, Goldman's numbers were down pretty dramatically for the second quarter, but just kind of looking on Bloomberg, you're seeing some kind of quarterly numbers even worse than that and significantly better than that. So I think there's still a lot of unknown out there in terms of what the hard number is, but it's the go forward outlook in terms of what's the pace of recovery thereafter.
Yeah, thank you, Wayne. Our next question comes from one of our anonymous attendees, and they ask, if we don't currently understand the economic impact of this pandemic, should we maintain caution or be defensive until we can see better what kind of shape the economy is in?
We have actually gotten more defensive within our equity portfolio over the last 30 days. This was something we did touch on last week, but we've rotated out of some of the more cyclical sectors and industries. Within credit, we've maintained kind of a higher credit quality bias. We don't own high yield. We don't own loans. We've really stayed to kind of the highest quality assets within both, the equities and the traditional fixed income allocations, because we want the exposure, because, we do want to participate as things get better, even if we may see a short-term period of weakness. But we also want to own what's going to be least kind of permanently impacted if things were to get worse, and likely most inclined to kind of outperform the broader market, and certainly the junkier assets. So we've gotten more defensive within what we own, but because of recent valuations, we like owning them at these valuations for investors that are thinking a year or more out. Trying to time the bottom or waiting out to see if things get a whole lot worse before adding risk historically just doesn't work, because you inevitably miss a day like Monday where you were up 7%, or a day last week you were up 9%. I think we've seen in just the last 30 days that equities and bonds, quite frankly, can rally up just as quickly as they move down. And you do want to be invested to capture the upside. I think being careful about what you own along the way is what's most important, though.
Yeah, thank you, Chris. Our next question comes in from Joshua, and he asks, what about energy and MLPs? What is prospect and triggers for potential recovery and longer term prospects?
This is Wayne, and I'll comment a little bit about this. We reduced our energy exposure. I'm just kind of tagging on the back of the comments Chris just made. We did take a posture where, even though we increased our equity allocation, it did move into a more defensible aggregation of managers, because we didn't want to make a bet in terms of what that kind of recovery and expansion would look like and the timing of that. So because of that, cyclically sensitive stocks our exposures, we've cut dramatically. Energy falls within that bucket. It is highly cyclical, both from a commodity perspective as well as a company perspective. It is very cheap, and it has been cheap for a really long time. And it doesn't matter. Like people are have been nervous about the energy construct, despite the boom that we've seen in the U.S. in terms of kind of energy production. So, because of the uncertainty around kind of macro effects, both domestic and internationally, we reduced our energy exposure. It seems like there is what's it called, Russia and OPEC, kind of namely Saudi Arabia, are getting closer to the table to kind of hash out a deal to kind of cut back on production. But cutting back on production on lower demand anyway, it's like, sure, it kind of staves off some of the downside, but it's still down. So that kind of pressure is, if things do well, it'll rip back hard, but we don't feel it's worth the trying to chase it right now when there's still so much economic uncertainty. Same thing with hotels, cruise lines. These are more cyclical, where you don't necessarily need to be early to make good returns, but we do need a little bit more of a foundational conviction on the path of economic growth before we get bigger there.
Yeah. Thank you, Wayne. We are nearing the end of the questions in the queue, so just a heads up to everyone on the line. If there is a question you would like answered today, please go ahead and submit that. And if not, we will go ahead and answer this last question and move on to wrap up the call. This question comes in from Brian, and he asks, where do you think the value is in fixed income if you are willing to take risk? Can you rank for favor in spaces in fixed income from both risk and reward, value, and potential returns?
Yeah. I apologize for the really long-winded response I had on the first question, but I think it just kind of shows where our interest and focus has really been in over the past several days and weeks. But within fixed income, I think it's more of a pacing. What's going to make strong returns within the next quarter, few quarters, versus what's going to be a multi-year kind of return opportunity? Distressed investing generically is going to be highly, highly attractive, because equities, from a large cap equity perspective, talk about the S&P. The S&P will be the first thing to run back, to rally hard, and in a more benign market, S&P constituents will be the winners in an expansionary economy. The distressed companies, the companies that really have weak balance sheets or did not have the wherewithal to survive the cyclical downturn, they're going to come under significant pressure and are going to create interesting opportunities for distressed investors to participate in. So we think that's going to be a multi-year opportunity. We're seeing that from our underlying investors, upsizing deals and ability to participate in restructurings. That will be, you'll get multiples of return on your money if you go through that cycle, but that will be a multi-year cycle. The TALF opportunity within structured credit, once again, buying AAA, AA, top of the capital structure, securitizations and structured credit, and getting government support in very, very cheap financing, that is highly, highly interesting today. And not everyone can do it. You cannot just go to your next distressed fund and say, hey, can you raise this fund? Like, you actually have to have access and relationships internally with the government to be able to, with the reserve, to be afforded the liquidity and the liquidity structures around it to buy into top of capital structure assets and generate good returns. I think that's really interesting. The opportunity set is not going to last for that long, but the risk reward there is really good, making, into my comments, mid to high teens type returns over a relatively short period of time in a much more defensible position. We would love to be able to talk more about this opportunity with clients. Yes, I'd say those are the kind of two elements that I kind of focus in on. But broadly, structured credit, CLOs, CLO equity at deeply discounted levels just because of mark-to-market effects, that's interesting as well. So there's a lot to do in fixed income across the risk spectrum.
Thank you, Wayne. Our next question comes in from one of our anonymous attendees, and they ask, as results come in from investment managers for March and overall for the quarter, how should we put them in context given the severity of this decline?
I'll start and let Wayne finish with this one, being that that's really his world. I think I would just caution investors that there was nowhere to hide in March. It was an unprecedented month in capital markets, across equities, across bonds. Unless you owned cash or treasuries, you were impacted, and likely will be surprised by many funds' performance during the month, because it was such an extreme risk off in a very kind of short period of time. And to Wayne's earlier comments, it wasn't just the lower quality assets. High quality assets were sold off during the month because investors wanted liquidity. I mean, muni bonds is a great example. The muni market had a really difficult March. Municipal bonds are historically kind of a low risk investment, but because folks wanted liquidity, they were selling anything that they could. And March was an extraordinary month across all strategies and all asset classes, truthfully.
Yeah, and there's a broad, there's a lot to talk about here. I mean, there's a lot to talk about across a lot of different things, but when we look at kind of return experience versus what the markets have done, I would say when you look at the underlying asset classes that the fund was invested in, they largely caught the beta in that period of volatility, in the sense that in short-term periods when volatility spikes, and by spiking, we exceeded 2008 levels, correlations all go to 1, and it doesn't matter if you own a defensive thing versus an aggressive thing. It all sells off. So in that short term, you saw everything move out, and you saw intra-month numbers that looked really, really bad. In the back half of March, what you started seeing was a rationality coming into the markets, and you're seeing that now too, as volatility steps down to 40 on the VIX. While we're still in a down market on a year-to-date basis, there's more rational buying and selling with less aggressive ups and downs. And I think there's more rational trading in the sense that utilities are more defensible, so that stuff should hold in. Healthcare is a high-quality growth, kind of secular industry, and that should have a good growth opportunity or good growth prospects. So that makes sense. Same thing with staples. We're seeing that now. We saw that in the final few days of March, and we're seeing that right now in the first few days of April. So we're seeing much more rationality in performance, and the calendar days are the calendar days, and that's kind of where you set the marks. But I think in a period of a little bit more normalcy, we're seeing more rational kind of pricing, and from that perspective, some of the things that you're buying our managers are buying more. I would say they're more offensive today than they were a month ago or 2 months ago because they're seeing things priced attractively and are good entry points.
Thank you, Wayne. And Chris, unless there are any more comments at this time, there are no remaining questions in the queue. I would like to thank everyone on the line for taking some time out of their day to participate in today's call. Thank you, Chris.
Thanks, Darcy.
And thank you, Wayne.
Thank you.
If you have any additional questions that we were not able to address during the call, please do not hesitate to send them to me at dobrien@simonquickadvisors.com, and we would be happy to address them offline. Thanks again for joining us, and have a great evening.